Yeah, I think before we sort of get into this final, push here, obviously, Joe, I got to compliment our trading lately. This is kind of goes into the play on technology that we've liked to own. Our rational equity armor strategy, which owns 30 to 50 equity names. We probably have a little bit more bias towards those AI kind of names. We're up about 12.5% this year relative to the market, up 13 and a quarter. We hedged out the downside in the April volatility event. So cut that drawdown in half, but yet we're getting almost all the participation to the upside. So this is a 90 scenario of volatility up, market up, and this is why our strategy has been working so well. Joe, why don't you kind of set the comparison of what things could look
Yeah.
like?
So here's what I wanted to talk about for today. I know it's been kind of a long intro, but I've seen this chart circulating online a lot. People talking about this bubble, comparing the .com with the AI bubble, and they're saying, hey, the .com bubble really started when Netscape was introduced in 1994. ChatGPT introduced in 2022. Like those are two, obvious like natural starting points for these two bubbles. They were kind of looking at the S&P. Maybe it looks a little bit closer correlated than this. I want to look at the NASDAQ because I think technology is really important here for when this comes. But I'm kind of saying, hey, yes, we are in this tech expansion cycle, but I'm actually thinking more of the parallel of the rate cuts. Now, in 95, the Fed cut rates. It was after we had lowered rates or raised rates after we had a big recession, early 90s, lowered rates, raised them again after the economy got hot. And then when the economy was, cooling off a little bit with these higher rates, or they were maybe worried, they saw, hey, there wasn't a lot of inflation, we can cut rates again. They cut rates. Right here. So they cut rates in June of 95. The same thing happened in 2024. The economy was kind of strong, wasn't necessarily needing a rate cut per se, but inflation had cooled off a ton, and they were saying, hey, inflation's on its way lower. We can start cutting rates here. This happened, remember, September of last year. So you kind of look at these two charts and say, where are we in that spot? Well, this is exactly where we are. And we had basically a year of a great rally here, which is, I think, we're potentially setting up for. And then we had an emergency. We had a couple of emergencies happening back to back. We had the Asian debt crisis. Remember, we were talking about Argentina at the top of the show. We had the Asian debt crisis causing a ton of volatility right here. And then we had the Russian debt crisis with the long-term capital management issue right there. We had an emergency rate cut happening right there. So, that's what an emergency crisis can do for a stock market. It can fuel, this parabolic growth here. So we have not seen anything like that. We've not seen, this race to the bottom like culminating here, but we're also not seeing like this ridiculous overpricing of these assets like we saw in the late 90s.
Right. It is very comparable, very interesting how you really lay this out, like Netscape, ChatGPT, the creation 2022, late 2022 versus Netscape in 94. The economy starts growing again. Things look good. Inflation starts coming down. We get the rate cut in 95, same as September of 2024. So here we are a year later. It does really feel like 1996. And my gosh, I mean, the NASDAQ is the chart on the right. It goes basically six-fold higher, 600% increase over the next 3 years after that. So, I mean, so let's just say that was a bubble and it wasn't, 3 years. Really, the NASDAQ got there by, the 2000, call it 2005, 2006, right? Back up to those levels again. So let's just say it's the next 6 or 7 years up six-fold. I need to own this market right now, right? And like I said, this is not the quadrant of owning bonds, right? I want to own this with some volatility, some hedge on. I probably want to own some hard assets too, in case inflation sort of rears its head again. But this seems very 96-ish right now.
Yeah, and if we're just looking at like this 96 to 98 period here, yes, this was a tremendous rally. It was nowhere near how good the rally was the last year, but this was tremendous rally here. And it had crazy bouts of volatility while we were having this amazing rally.
Yeah, why don't you show how the VIX looks versus this sort of move here? I think we got a chart on that, right, Joe? Yeah, right.
Yeah, just looking at this, I switched it over to the S&P 500 compared to the VIX from 95 through 98, and just kind of see how the market, of course, rises. We all know for this period, but volatility was rising also.
Yeah, so this is what we're talking about. We've already started seeing higher lows on the skew index. I think we're going to start to see higher lows on the VIX. That should translate in pushing that price up. And this is where owning stocks with long volatility, sort of as your 60-40 treatment, right? To sort of dampen down risk and mitigate that. That's why people in the past had owned bonds with stocks that worked very well after the credit crisis in 2008. They drove interest rates to zero, but that was predicated on rates going lower. Now we're in I think an area where it's stocks higher, volatility higher.
Absolutely. And bottom line is our thesis has always been over time, given a long period of time, the stock market will go higher. I just am a firm believer in the U.S. exceptionalism. I think we are a fantastic country that has been able to produce this over the past 150 years. And I think see no reason that's going to stop anytime soon. You look at volatility on the other hand, though, give volatility a long period of time, it'll go up, it'll go down, it'll wind up back in the same spot, though. It'll mean revert back to the average. But when you're in a bubble, crucially, you're going to get a period where the market's going higher and volatility is going higher. I think that's exactly what we're set up for here for this bubble, where we're going to see volatility and the market rising at the same time. And I think it's going to be the right way to be trading this bubble is having stocks on. Obviously, I need that, but I also need volatility because this bubble is going to be bumpy as we're riding it.